product slash portfolio manager at the crypto exchange. That's why I'm bringing up this topic, because it's part of my social responsibility to educate people financially, especially about the investment, right? So yeah, given that the market's kind of bullish with the news of halving coming up in the, I don't know, maybe like end of April. It's not confirmed yet, end of April or early May. So maybe we want to talk about how to optimize our crypto portfolio. So let's start with this one old saying that we should not put all our eggs in one basket. But that begs one question, right? How many eggs should be in one basket? Eggs in one basket, and sometimes some buy for the hype, sometimes because of the vibe they relate to the project. Some just buy the top 10 market caps and then just split equally in the weight. But is there any way to optimize the holding? So yeah, the material was taken from my study here. This is my alma mater, the MS in Finance, Technology and Policy, and also my day job as well, with some financial modeling. So we can borrow a concept from traditional finance, which has been around since way before crypto. It's called the Markowitz portfolio optimization. And Harry Markowitz and William Sharpe received a Nobel in economics in 1990 for this technique. Maybe you're familiar with Sharpe ratio, because there are, when you see or when you evaluate a token, a security token, then you'll see the data for the Sharpe ratio. That also applies for the stock as well. So, okay, no problems. So, I'll walk you through the risk-return relationship, investor's utility, and also adjusting the optimal switch. And the end of the presentation, I will also walk you through the case study that I took the data from Binance to see how it's put into practice. Some common terms I'm going to walk you through as well. And forewarning, if you see a lot of mathematical equations on the slides, don't get discouraged, because that's how we evaluate the money, the assets as well, with the mathematical equations. So there are three, well, the rule of three, the magic number, so it's easier to digest. First of all, we have to understand the returns and risk, or basically the returns profile of our tokens in the portfolio. And then we do solving for the optimal weights. And the last one is, I don't do this because it's a bit difficult to assess the individual investor's risk score. But yeah, that's actually part of the complete portfolio creation. So return and risk, I believe we are familiar with the concept, but just to reiterate, return is basically the comparison of after and before. We usually use the close price from the traditional stock trading, although crypto doesn't actually have the close price, because we don't have the stock market trading hours, right? And then the risk is quantified for the uncertainty, investment uncertainty. It's measured as the standard deviation, which is the dispersion about the mean. And why is it not variance, although in English language, variance sounds more intuitive, right? But standard deviation is the first degree, while variance is the quadratic, so it's easier to intuit the concept. Yeah, so the equations. You can calculate returns with the simple returns, basically the difference, the fraction of the difference, or the logarithmic, but that depends on your purpose. In this case, in my case study, it doesn't really matter, but logarithmic is more used for if you want to evaluate in the time series. Risk, as I mentioned before, it's variance, the square root of the variance, which is the standard deviation, and it's in the first degree. What is COV here? COV is actually covariance. What's the difference between variance and covariance? I'm going to explain it next. say you've got more than 2 tokens in your portfolio, and then you want to know how these pairs, because say you can evaluate one token to another token, how do they move? So if one token goes up in price and the other token goes down, that means the correlation is negative, and that's actually your hedge, or basically minimizing the risk. Hedging is minimizing the risk. And you can evaluate that with a measure called correlation coefficient, the Greek letter rho here, the correlation coefficient. And the covariance is basically the multiplication result, the product from the correlation coefficient and the standard deviation of 2 assets. So yeah, we can skip the equation here, because to be honest, like Excel, Python, whatever libraries you are using are able to calculate it without you understand the math under the hood, but it's good to know always. Yeah, so if you see, later I will show you the correlation matrix. If you see the number, the correlation coefficient is low, then it minimizes the risk. But if it's high, say 0.98, 0.99, then the 2 assets in the pair actually move together. Oh yeah, the good point is risk quantification is actually independent from return quantification, because you see in the equation here, there is nothing related to the return. So it's purely based on the standard deviation and the correlation coefficient. That's why in Markowitz style, in Markowitz technique and Sharpe ratio as well, the chart would be, the x-axis would be the risk and the y-axis would be return, because they are 2 independent things. So yeah, from the prices data, which I will show you later, I got from Binance API, we can calculate the return, we can calculate the correlation coefficient, and consequently the standard deviation. The dotted line here, because like I mentioned, some packages, software packages, can calculate the standard deviation directly without calculating the correlation coefficient. So yeah, now the heart of the problem, how to determine the weight. This is an optimization problem. If any of you are developer, you realize that optimization always have this kind of gradient descent technique, also some optimization iterative problem solver and stuff, and Monte Carlo. What I'm doing is going to be the Monte Carlo simulation. So for solving for the optimal weights, we have at least 2 constraints here. First, the sum of the weights should be 1. Why? Because say you want to well, it's your portfolio. The amount, the total of the weight should be 1 or 100%, and each individual weight should be greater than 0 unless it's a shorting position. So if you're not familiar, long and short position, long is basically like buying, and short or shorting, basically you borrow an asset to sell later because you want to pocket the difference from the selling proceeds. That's basically what caused the economic crisis in 2008. That's why the movie called The Big Short, if you have ever watched that. Yeah, the methods for finding the optimum weight can be done in several ways. Monte Carlo is the random number simulation. Basically, you run the simulation throughout. What I did was like 10,000 iterations, maybe more. The other one is the spreadsheet or Python library that has the optimization solver as well. Or, like I mentioned, machine learning gradient descent style. So for example, this one, let's get back to Markowitz. Okay, I know I might like get to your nerves because it's for too many equations. But Markowitz portfolio optimization, why he got the Nobel Prize is because he introduced the concept of frontier. Frontier is basically if you see the 10,000 iterations there, you can take the outer lining, basically the the dots are on the outer line. That's called the frontier, basically a graph of the lowest possible standard deviation for each return combination. Say I want a return of 5%, and then you draw a horizontal line, and then you meet the outer lining, right? And then you draw the vertical line below, so you can get around standard deviation of 6.3, 6.5%. So anything inside the portfolio lining, the frontier lining, is not efficient. Yeah, and everything above the minimum variance or minimum standard deviation, say maybe the minimum standard deviation is 4 point something percent, 4.9, 4.8% there. Anything below that, because you can see some dots are still below that, is not efficient. Everything that is above that is efficient. So we go to the pop quiz. Why is it called efficient? Consider the shape of the frontier. So can anyone intuit a reason why it's called efficient? If not, okay. Let's get back. It's called efficient because you see for the same standard deviation, the same risk, say I draw a vertical line from the 8% standard deviation, basically standard deviation of 8%. I draw a vertical line. I meet at least two portfolio on the frontier. So the lowest return for that 8% standard deviation is 3%, 3 point something percent. But the highest return I can get with the same risk level for the same standard deviation is around 6 or 7%. So why, and they have two different weights combination. So why would you want to go with the only 4% return if you can get the combination that can give you like 6% or almost 7% return? So that's the idea why it is called the efficient frontier. Anything above the minimum standard deviation is the efficient one. Yeah, so another concept is the Sharpe ratio, why it is all over the investing website in asset property. Sharpe ratio is basically the slope in the linear slope in the capital allocation line. Okay, crash course again. What is capital allocation line? Capital allocation line is basically the red line that shows the percentage of risky portfolio and the risk-free asset. I'm going to talk about the risk-free asset later, what we use usually for the risk. So a slope is basically the delta y divided by delta x. So if an asset has higher Sharpe ratio, for the practical tips, if you read the asset detail or token detail, higher Sharpe ratio basically means higher return for consequently higher risk as well. Yeah, this is basically the formula: the expected return minus the risk-free rate divided by the standard deviation. And I use the example of 3%, but it can be anything if you use the current T-bill rate, 3 to 4%. Other parameters, so there is not only one ratio like Sharpe ratio. We've got different things, but just like I mentioned, you can set the maximum Sharpe ratio as your optimization goal, or you can set the other ratios for the optimization goal, or like I give you the example, you can plot the frontier, you define your minimum return, and then you find the portfolio weighting that gives the minimum standard deviation. And yeah, the last step is basically something that I or our company don't really do, although we've got the investor profile, but to transform the investor profile, investor personality into loss aversion score is something that we haven't really explored yet. But you can basically, the end result for this exercise step 3 is actually say X% goes to the risky tokens and Y% goes to the risk-free asset in token form. That's why the other day I asked in the Telegram group, does anybody know how I can buy a T-bill, because I'm not the US person, how I can buy the US T-bill in token form? And yeah, some of the suggestion actually require me to be an institutional investor, which yeah, definitely not, because it requires a lot of money. So application example, if you know Enzyme Finance, it's the one of the DeFi protocol. They've built funds around the tokens, and you can see they disclose the allocation, the asset allocation here. Fund Bitwise and then GDLC, and there are a lot of things actually. You can Google crypto index funds. Each fund management has their own funds. That's what we do as well. It's very, you know, like sometimes trade secret, sometimes not so secret, about how they build the weights. And yeah, like I mentioned, it's not necessarily Markowitz. It can be just like market cap weights. It can be based on the liquidity level, and there are all sorts of other techniques they use. So this is the conclusion. From the prices data, you can get the portfolio return and correlation coefficient and the risk. You can build the risky portfolio of the asset allocation. And if you know the investors' loss aversion score, then you can also build the complete portfolio. I go to the case study. Binance API data from 1st of October until earlier this month. I'm using the Monte Carlo of 10,000. Since I picked like random tokens, as long as the baseline of the spot trading is USDT, so I didn't know what I picked. To be honest, I just Googled yesterday like what OM stands for, prong dash, and although we are an exchange, sometimes I don't really memorize all the tickers by myself. So yeah, these are 13 assets, 13 tokens. Calculate the returns. Since 1st October and it's weekly, so you can get the return. I use the simple returns. Why I put the standard deviation in the highlighted box here, because we can see later in the result of the optimized portfolio that the optimized portfolio standard deviation is much lower than individual assets, at least for some or the majority of the assets. Say it's got almost 30% of standard deviation. You can see later that the portfolio standard deviation would be around only 8%. Correlation matrix that I showed here, see there are negative numbers, and also there are it's the heat map colored bar there. The highest or like the higher correlation shows that the two assets work together, move together. But there are at least two tokens here, like PLN or RON. They are the hedges. They have the negative coefficients. Then this is the Monte Carlo of 10,000 iterations. It's very quick because it's done in Python and the calculation is not really computational expensive. randomize the weights with respect to sum is equal to 1. Plot up on the chart as the result. The color, the gradient color for the dots are representing the Sharpe ratio. The scale is on the color bar, the heat map color bar. And I took the risk-free rate of 3%, but of course it's something that you can set arbitrarily as well. And yeah, see the result of, because I want to compare, like, the weighting is the secret recipe of each company, right? So if I took the baseline of the equal weight of the 13 tokens, say it means like each token weighs 1/13 of the portfolio, like how much is the return and the standard deviation. So that's why I compared that. And for the baseline of the equal weights, so 1/13 actually has modest return, but still lower than the optimal portfolio, and its standard deviation or its risk is actually closer to the optimal portfolio anyway. And if you take the lowest risk, that's basically the minimum variance or minimum standard deviation, the return is actually still even lower than the risk-free rate. So yeah, and that's the pie chart to visualize of these 13 tokens. So yeah, I hope you can explore more of this Markowitz portfolio optimization. You can apply it for your holdings if you've got different tokens in your holdings. But of course, that's personal preference. That's okay if you want to split your assets into based on market weightings or whatever you like. But yeah, this is just one way to optimize your holdings. I think that's all. Thanks very much. And questions?